closes up more than 300 points, ending a 5-day losing streak. This is on the heels of everything that we heard on Friday, with Signature Bank shutting down, Silicon Valley Bank shutting down, and who is next? Well, we don't know, but we don't care because the bulls are back and running on Wall Street again. Hi, everyone. I'm Todd Schoenberger, and I am joined by my friend and co-host Tobin Smith out in sunny and hot Scottsdale, Arizona. And Toby, we were busy all through the weekend. You and I spoke throughout the weekend. We were talking about what we may have seen on Monday. Then you have the inflation data coming out this morning. Who knows? Who knew what we're going to see? We still have yet to know what's going to happen. We have the critical PPI data coming out tomorrow, and obviously the Fed meeting next week. But what do you think right now, Toby? What should investors be doing right now?
Well, the first thing you should do is, do the opposite of the panic. It's like the first Twitter panic I'd ever seen, right? All the venture capital guys got on Twitter and said, "Pull your money out," and they created literally a mob of mania. Secondarily, we did get the inflation data today. I know you've been working hard, and it was exactly what the forecast is, because now all the math is easy to do. You just have a spreadsheet, and all you do is make an assumption on what the shelter cost is going to be year over year.
Right.
And year over year, we know exactly it's going to be about 3.5% to 4%. You then go to service wages, plug that number in. And so guess what? Shockingly, year over year, inflation is still 6% at the gross.
Yeah.
And if you take the core, it's about 4.2. So none of that should be surprising. What was intriguing to me about the whole debacle at Silicon, not silicon, Silicon, it's an element, you bonehead. I talked to so many CNBC people today, including Melissa Lee, and said, "Melissa, I love you. Would you just say Silicon and not be, dopey like Todd?" And,
which is called SVB. SVB.
Yeah, SVB. Right. So anyway, forest to the trees here. They are such an outlier to what normal banks are, obviously. And everybody, I think, now knows the story, is that when 96% of your deposits aren't covered by FDIC, they're concentrated in 45% of the startup companies in the United States. You may have a little bit of a concentration problem, and then on the deposit side, and then on the yield side, which somebody's going to write a book about this, how on earth you could buy $228 billion worth of mortgage-backed securities and bonds, U.S. bonds, and not hedge the risk. A blind dog with a cleft palate and a note tied around its neck, first semester of Econ 101 would be that, you have default risk in a bank and you have interest rate risk. The underwriting of the loan is supposed to, give you the default risk help, but the interest rate risk is you just do, it's called an interest rate swap. That's why, there's futures out there, and you do them with investment banks. Everybody in the world, evidently, except for Silicon Valley Bank, did it. And so that what that really, I think what yesterday was more about was like people saying, holy shit, you have California regulators, you have federal regulators, you have KPMG, who gave them a clean bill of health 24 days ago. You have the California Regulatory Commission gave them a clean bill of health. I mean, for God's sakes, you even had Jim Cramer recommending the stock, for crying out. I mean, so they had every gold-plated, person out there, and yet they just missed this teeny-weeny little thing. And that's what I think scared people more than anything else, Todd, because it would be basically like you went to go take a driver's test and you said, "Where's the steering wheel?" It's so basic, 101.
You're right. And it wasn't just Jim Cramer from the financial media aspect. Forbes magazine came out and actually listed SVB as one of the top banks in the country. And this was about maybe 45 days ago that they had that publication out. So there were several things there. You have to wonder, though, when you heard Jay Powell go to Capitol Hill to give his semi-annual testimony last week, I'm wondering, did anybody slip him a note saying, "Hey, we might have a bank that's in trouble"? I mean, it's hard to imagine that nobody knew this, and I think
I
that's
mean,
where that's a
well,
head scratcher.
yeah, I mean, it's even more of a head scratcher if like here's like the mechanics of the whole thing. If you're in the Federal Reserve System, all the stuff that you own for the deposits that have been given to you are either two things. They're either marked to market if they're not available for sale, right? You're theoretically holding these things till maturity, or they're not sent because you can sell them at any time. Those are your assets, right? You got deposits and you buy stuff. How all that information is real time. It goes to the Fed 24/7, 365. You just wouldn't think there was like a little, code written into their spreadsheet that said if a bank has more than 50% of their deposits at risk with interest rate risk, then show me where they're hedging it. And that's what blows me away, Todd, because it's not like this is 1924 and they're like sending the running boy on the bike with the ledger right up the street to go to the central bank. It's all automated. It's 24/7. So that's that's what really sort of shook people. If you understand the insides of this and how it all works, how you could make a basic mistake like that is incomprehensible.
And not only that, after 2008, we had the mandated stress tests. I mean, I was thinking about it over the weekend. Where were the stress tests on this bank? This is the second largest bank in the country to actually collapse like this.
But it was under the 250 billion limit. They were at 234 or 226, depending on what you read. They did that on purpose, Todd. That's the other thing. Remember, all of a sudden we had, I don't know if you remember this thing, it was called the pandemic. I know you were asleep for about 2 hours during that whole thing. And they got this huge influx of money. They got the inflow of all those IPOs, those crazy SPACs, all that malarkey. Yeah. And they went from 78 billion to 240 billion-ish in 2 years. They bought high yielding or relatively at that time. Remember, what was the yield in 2020, 21? It was nothing. So all the things they did. So I don't want to beat the dead horse here, but it is mind-boggling. And that's what I think shook other people up. Then it was just, shoot, fire, aim. Whoever had a business model that was closely remote or that did a lot with entrepreneurs. So boom, that was gone. And First Republic, boom, that got, blown up. So that's what a panic is. We actually made some stupid money in options because, when I think I set this thing out on Wednesday that this was starting to get going. So we shorted or bought put options on a number of banks, including them. Well, I was more worried that they were going to just shut them down, which means the stock was going to start trading and then we wouldn't be able to cash in the options. And so we sold most of them by Friday. But there was a way if you're a trader to make money from this. But to the regular investor, the world, as I think we said on Friday, we knew that the Fed was going to have to come in and guarantee these uninsured deposits, because then we would have had, and this is a technical economic term, a serious shit show. Because now all of a sudden people are, and oh, by the way, there's two other things that just got me at this. This is like the first Twitter induced bank run, because all the VC guys are all Twitter whores, and they all put on their, on their posts on Twitter, you got to pull your money out of, that, and then hashtag pull your money out of SIMV was like the number one. When you wake up in the morning and you see that's the number one hashtag on Twitter, you may have a problem.
Yeah, no doubt about that. What I thought was interesting, though, speaking of that, is that there was so much venture capital money for some of these companies that, the angel investors, whatever you want, $10 million. And there are numerous stories in the press of these companies that have $10 million sitting in a non-interest bearing checking account. They're just barely using the money for operating expenses. It's like, wouldn't somebody put that money in commercial paper or something, like try to make some money off of it? I thought it was a bit bizarre that they're pretty much their entire cash reserve was sitting in this checking account. And just like that, they have a problem. So it does. You definitely need to diversify that.
Yeah, I talked to a few venture capital general partners today, and all of them look me in the eye. Of course, this is on Zoom, so you can like lie. You can take your glasses off. But they said that, if they're going to give money to someone, and particularly in a startup bootstrap type of thing, and it's going to be any reasonable amount of money, that they force them to put it in multiple banks. I mean, that would just be the prudent thing to do. Silicon, though, I mean, you say if you go to the Silicon Valley, I live in California and grew up there, it's like the Matrix. They're part of every 45% of all startups since 2010. I mean, that's an amazing number. So they just, no one looked underneath the hood, because, hey, man, regulatory agency says it's good, California says it's good, stock market says it's great. Stock went from 70 to $320. Mm-hmm. Their earnings, went like a Viagra chart, and so it's just a sleep that people took, and then to stay with the other stupid metaphors. Then yesterday, like the baby was thrown out in the bathwater, right? Some companies that had nothing to, not related to this all, are down 30 or 40%. So we bought Schwab yesterday. That was the silliest one. I
know. Lost a third of its value over the last 3 trading days. Truly remarkable.
Yeah,
for Charlie Schwab.
And I can understand as a broker. I can understand if you have the thesis that people who just had cash in their brokerage account and they didn't buy, let's say, the SSWB, which is their Schwab 2-year paper. It's basically a money market fund, right? The money market fund pays like 4.5%. Mm-hmm. And people were worried about this, transition or transformation where people were going to take the money they put on deposit, where they're getting about 75 basis points. Why would you not go to freaking 4.5%? Particularly, if you wanted to be in cash because you were trying to be defensive, you could reinvest the dividend. Blah blah blah. Now, that in itself was not going to change their value. They own, they're a very conservative balance sheet. They own 2-year paper, 2-year bonds, and they have to buy them every year, Todd. So some of them are underwater. That's no secret to anybody. But everything else of their balance sheet is so conservative that was a part where there was misinformation, disinformation going, probably because of Twitter as well. So we got a chance to buy it, and it's up 15% today, and it's they're going to acquire. I guarantee you, they're going to acquire some banks. They're going to acquire some other people in this, because there are some slowly dying firms out there, and that's what happens. But my point was that we knew that the Fed was going to have to guarantee these uninsured deposits, because and so that's why we closed out our shorts. We could have got more money if we stayed into Monday, obviously, but I thought that when they did do that was going to say the stop the bleeding, and it did not. My Lord, First Republic. Those guys have been around for 70, 80 years, maybe 100 years. Yeah, that was amazing. So we bought some of that stuff today too, because that was just automatic selling. There wasn't a human being selling. It was just people selling an ETF. The ETF had to then sell, blah blah blah. And then short covering crazy. So is the world have come to an end? No, Todd.
Nice work. Nice work on that, on picking that up. So I'll tell you what, let's go. We're gonna take a quick break. We're gonna come right back. I really got to get your thoughts, Toby, on the Federal Reserve meeting next week and what they should be doing because of this news in the banking sector. So we'll be right back. Dow up 300 points, ending the 5-day losing streak. You saw so much news with the CPI. We got PPI tomorrow. We have Triple Witching Day on Friday. So much excitement. So you want to keep it here on Buy, Hold, Sell. We'll be right back after the break.
Buy, Hold, Sell Live, brought to you by Transformity Research.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Financial news TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember.
Oh, God.
Yeah, well, it doesn't. I want you to, oh, my God. Fast pace, no, oh, sorry.
Take one.
Fast pace, no holds barred, in your face, rock and roll style.
Woohoo!
Good sign.
Let's kick some
Welcome back, everyone, to Buy, Hold, Sell. We saw the Dow up 300 points. Bulls are back. Will they stay? We don't know. Toby, we were just talking about in the last block, all about the banking sector and then having the Fed come in and really help save the day and really provide some stability as far as investors are concerned. But what do you think the Fed is going to do next week? They have a critical two-day meeting. This is before their critical PCE data that they always like to read. That actually comes out next Friday, a couple of days after the meeting.
Yeah, but they'll have They'll have
no,
that.
So what do you think they will do? Because all the talk now is that they will be hiking 20. This went from 25 basis points to 50 basis points to nothing, no change. What do you think is going to happen?
Well, this is the intellectually interesting part of this dilemma. But it's sort of like basic logic 101. If the Fed had to step in and create these facilities, in the hundreds of billions of dollars, and they said, and we've put the whole thing on our back, things are fine, don't worry, then you can't come and say, hey, we're going to stop raising rates, even though a week before it was may have to do 50 basis points. Because until we get it to 2%, the war is not over and we are not done. So that's why I believe strongly they're going to have to raise by 25 basis points, because the message they would send the market was zero would be, oh shit, they know something. And because there would be, on a relative basis, the 25 basis point doesn't mean squat, but on the confidence and banking it's just basically monetized confidence. Look back to the 20s, look at the 50s, look at the 70s, look at every crash is a loss of confidence. And the Fed right now is the real big kahuna about making people feel confident enough the system's working, the rails are there, the guardrails are there, except for SIBP. And so that's why he'll if he doesn't do it, I would love to be in that meeting. Because if somebody says, I think we should not, somebody's going to slap that person and say, are you an idiot? Do you read? I mean, what are you, 12? I'd love to be in there for that one. That would be fun. So it's a done deal.
The last meeting, there wasn't a unanimous consensus that, let's slow this down to 25 basis points. There were a few Fed governors that were thinking maybe we should keep it at 50, at least for that last meeting. We didn't see it. Then we had a lot of Wall Street economists coming out saying, no, it's actually going to be maybe one or two more, and then that's it. And that's all we're going to see. And then obviously there was a narrative about potential rate cuts at the end of the year, which I think is absurd.
Yeah, well, that's malarkey. But
that's the whole thing.
Todd, how about this? The 2-year interest rate went from 2% to 4% in like a month, and it just jumped back to 2.8. It's the world record. Other than even in the great financial recession, the 2-year didn't jump around 200 basis points. That's like a lifetime of moves in 3 days. So that said that somebody was messed up, and people were off sides betting on that. And then you have to this is obviously this is the second largest one since Washington Mutual. But it was the speed of it. Even Washington Mutual, man, the carcass was, moving along 2 days. So I understand, that's what markets are. It's never a straight line, and every other cliche that I can think of. But at the end of the day, they did the right thing. They're going to do the right thing with 25 basis points. Mr. Powell still wants to go down in history as the guy who broke inflation, just like his hero, Paul Volcker. He does not want to be Arthur Young, who got his ass kicked out onto the street because he started cutting rates too early, and we got, the inflation of the late 70s and 80s back. So, I'd be calm about that. I'm more interested actually in why oil prices were cratering, in the last couple of days, because that's sort of a, one of the thesis on
That's
oil.
a proxy. Yeah.
China's going to be opening and reopening and, blah, blah, blah. I thought that was more intriguing. But the big show is the big show. So,
yeah,
I mean,
you're right about that.
Really, as an investor, we bought some, again, we bought some banks today. We bought Schwab, we bought Truist, which is a combination of a bunch of banks in the Northern Virginia area, Southeastern area, and they also have a major investment bank. These guys are going to, like Schwab's making about a 52% profit margin, gross margin on what they do.
Yeah.
I mean, it's incredibly profitable business. And for it to just be, Charles Schwab, I'm sorry, Chuck, you went from the, 25th richest person in the world to the 68th richest person in the world.
Yeah.
So I'm starting to tear up.
Well, the one thing that I couldn't understand, and I'll leave you with this one, Toby, is that on Friday we saw, we had this jobs report beat expectations. So we did see participation unemployment actually rise. But with that, I could not understand why Bloomberg actually had their poll from Wall Street Economist showing that the terminal rate was, or traders were thinking 5.7. Then it dropped to 5.1 with the SVB collapse. And then all the talk was, the Fed can't do anything with a rate hike at their next meeting. And I'm starting to think, hold on now. That's a knee-jerk reaction. Let's take a look at this, because just 12 hours prior to all this, we were talking about 50 basis points. Now we're going to zero.
Yeah, I mean,
the
spreads are, the spreads between 10-year, 5-year, they were all showing that the expectation, the terminal expectation rate was 5.5%. That was like 3 days ago. And then it went down to 4.5%. I mean, come on.
Yeah,
so
I know.
That, what now the cliche, the other cliche, the Fed, is going to raise rates and things are going to break. Well, SIVB didn't break. They were just boneheads. They just got their teeth kicked in for, being asleep at the wheel for 2 years.
Poorly managed.
Particularly 9, incredibly well managed. And then KPMG, I want to see that lawsuit. That is going to be, because if I'm a shareholder and if I've lost money, I'm going to the auditor and for the bill of health. Oh, I mean, big time. So
I didn't even think of that. That's brilliant. You're absolutely right. That's a big one right there.
Yeah. So I mean, we're all human beings and we make mistakes. We always learn from the mistakes. We're going to get more regulation, that. And if you get more regulation in a bank, et cetera, then the costs are going to go up. Their FDIC costs are going to go higher, because for every deposit they take, they pay 18 basis points. It's going to go probably 25 basis points that they pay into the FDIC fund. People said the government's bailing out. No, the FDIC fund is doing the restoration of the values, and the banks pay for it. Now you pay for it indirectly because you're getting a haircut on your yield, but this is pre-funded. And Schwab got hammered because people thought that if somebody lost money that the SPIC, but the stock guarantee situation is completely different than the FDIC. So there was a lot of just panic selling, and just learn the lesson at home. Number one, when everybody's panicking, don't panic. Number two, look at the stuff. Look, if there's quality companies that you understand and that are down 10 or 20% for no reason other than the fact that there's panic selling, which is then beginning, panic selling and then getting momentum players who have to sell, blah, blah, blah. Take advantage of it. And, and three, have some cash available, have some liquidity available for when a shizzle like this happens. Just, going to the Snoop Dogg on shizzle.
Keep your powder dry. That's absolutely right.
Yeah.
So listen, Toby, we're going to leave it right there. And as we speak right now, we're going to close out the show. Futures right now are pointing to a flat open right now.
That should be.
Zero movement, not a lot happening. So I think a lot of people are waiting for that PPI data to come out tomorrow at 8:30. But we'll see what happens.
Wait a minute, is tomorrow Friday, Todd? Please
not
tell
yet,
me
not
Friday.
yet. No, true that, but that's triple witching day, so we're gonna have a lot of volatility. So we'll see. Got so much to do, so many things are happening. So listen, on behalf of Tobin Smith, I am Todd Schoenberger. Thank you again for joining us today on Buy, Hold, Sell. We'll catch you next time. Take care.
Cheers.